How's everyone doing today? Shankar Puri here, and today we're going to talk about the Bitcoin price and what's going on with the yield curve. The 10 and 2 year has inverted, and a lot of people are getting worried, thinking that a recession is just around the corner. So let's clear up some misconceptions of the yield curve and what it could actually mean for the markets in the next 3 to 6 months. So without further ado, let's dive right into the charts. Alright guys, so before we get into that, I just want to bring you guys attention to this visual here showing where cryptocurrency currently is. So again, this was I think done in 2017, so this is about 10x from where it is right now. But the cryptocurrency market comparative to pretty much every single market, so we're still underneath the US budget deficit, and that's definitely grown since the last time it was recorded. But just to show you how early we are in this market, and compromising your integrity or looking for 100x's overnight, play the long game. You have a lot of time. We have all these asset classes that are in front of Bitcoin, and if our thesis is that not Bitcoin only but all of cryptocurrency is pretty much going to be all assets are going to be on the blockchain in some way, we have a lot of room to grow, and we're really just in the beginning phases of the adoption curve of cryptocurrency and Bitcoin. So just keep that in mind as you continue and you're looking for these 100x coins and you're looking to make quick money, is that there's a lot of longevity in this industry and we're just getting started. All right, so just want to take a look at this ETH versus Bitcoin chart. So we have broken out. We've definitely broken out. We can anticipate a retest if that happens, nothing to worry, and then we can maybe head higher. But the breakout from this bull flag, from this bullish pennant, is very good, because normally when ETH breaks out against Bitcoin, it signifies altcoins will be doing well. And as you can see over the last week that's just passed, since we've broken out from here, a lot of altcoins have done really well. To mention, Luna's done well, Zilliqa, AVAX, Solana, they've all done extremely well. So what I wanted to talk about today, guys, is really focus on, well, actually, before we continue with that, let's look at our Bitcoin Wyckoff chart before we continue. So here on this channel, we've been tracking this Wyckoff accumulation schematic. So we've broken out and we should be heading higher. We're looking for higher highs on this chart. But yesterday, a lot of people, and maybe 2 or 3 days ago, a lot of people were very concerned because the price was pulling back. But here on this channel, we know that we have a support zone right here, which was previously resistance based on the price getting rejected over here. So we went up, broke out, and all we did was retest. So we had a retest. It looks like it confirmed, the retest confirmed. We had decent volume, pretty good volume coming in. So the retest seems valid. And as the weekend, so like I said, weekend price action, I do not trust that much. But as the weekend continues, Sunday night, as well as, in the week next week, maybe we'll get higher highs. We'll move higher where we're in the markup phase of the Wyckoff accumulation pattern. So that's what we're anticipating. We've been following this for 2 months, guys. So we've been level-headed. Haven't anytime we've gone up, we've dipped, gone up, dipped. We've maintained in this pattern that we have identified, and then also identifying the bottom here, which was a spring at 33. We said that 30. Yeah, or whatever this price was, 32 or 33,000 was the bottom before we start lifting off. So, nothing to worry about. We're going to get pullbacks. We got to pull back. Key levels we need to look at. So key levels that we need to look at. So Bitcoin is still under some negative air. We have some resistance. Is that we need to watch this price here, 47,300. Because currently, last time I checked, it was still valid. But let's see if it's been, yeah. So we do have a bearish divergence here on the chart. So It hasn't played out. Maybe it won't play out, but well, I mean, it just consolidated after the divergence, to be honest. But we need to watch this right here to break highs right here at 47,000. So we're looking to just watch the chart, and once we break above 47,300 around there, we can anticipate higher highs, or at least coming to 55,000. So that's what we're anticipating. Breaking under 44 and a half is very important. So breaking the support zone is very important. So the fact that we tested it and we're moving up is a good sign, but always remember, price can always come back down and come back into the pattern. So just be cautious of that. So we're looking for a break and hold above 47,000 to the upside for further upside. And if we break under 44 and a half, potential more downside. But we're of the camp that we are going to be starting the markup phase of this market. So that's what we are at right now. So what I wanted to talk about, guys, is the 10 versus 2 year yields. So if we look here, this is the 10 versus 2 year yields, and we've currently inverted. And every time we've inverted, shortly after, we've had a recession, maybe within a year after. But what a lot of people don't talk about, and what I've done is I've marked off, so this is the inversion that we're having now. I've marked off every time that we have inverted in the past and how far away it was from the top of the market, starting from, the 2000 crash. So the first time we inverted was 1998. And from that first inversion to the top of the market, we went up about 43%. And the top of the market came about almost a year and a half later, right? And the yield inverted twice. We had a second inversion in the same year, and we even increased 13%. So we had a massive rally before the crash. So if you took your funds out when you saw the inversion, you would have missed out on 44% to the upside. Even if you only got 20% of that, that's a lot of upside within 2 years. The next time we had the inversion was in 2006, before the 2008 crash, and we went up 25%. So about 25%. So, and I want you to be aware of the time it takes, right? It's not like we inverted and then tomorrow we crashed, right? So, I'm looking for, what am I looking for here? Where is that? So let's look at the time it takes. Okay, so from the first inversion to, let's say, the top of the market, it took 814 days, right? So that's a lot of time. From the inversion that we saw that led up to the 2000 crash, 643 days. So you missed out on that upside, 643 days. The other time it inverted was right before COVID. And how many days before the actual crash? It was 113 days. So there were just a little bit more than 113 days. And we went up 18% in that time. So what I'm trying to say is we still could have 3 to 6 months of upside. And normally when an inversion happens, it's actually, if we look at this, it's a sign that we're going to have we have a nice increase of price. Look at this, 42% within 814 days on the SPX. Here we have 25% in 643 days. And then here within 115 days, the SPX went up 18%. So that it's a sign that, we may have a crash within a year, but immediately after the inversion, we've gone on magnificent rallies. So what I'd like to also show you guys is most people are concerned about the 10 versus 2 year, but what we need to also look at is the 10 year versus 3 month. And every time the 10 year versus 3 month and the 10 versus 2 year yields are inverted, that is a higher probability sign that we are going to be heading into recession very shortly. So let's look at so this is the 10 verse 2. So we had the inversion, right? And we had the inversion in around 1998, recession shortly after. We had the inversion, that we showed on the chart in the 2000s, recession shortly after. We had an inversion over here, which led to the 2008, and we had the inversion right here that led to the recession right before the C-19 virus. So over here is a 10-year verse, minus the 3-month treasury. So what we're looking at here is similar to the 10 verse 2 years. Every time it has inverted, we've had a recession. So you can see here, right before the 2000 crash, we inverted, had a recession. Inverted right here, right before 2008, recession. So the charts are very similar. We inverted right before the 19 recession. But what is interesting to show is currently we have an inversion on the 10 verse 2 year, but we are not having an inversion currently on the 10 verse 3 month. So this has led me to question and say, I do not think just because the 10 verse 2 year has inverted, we're going to have a recession in the next month or two. It could be 6 months, 12 months out. But this is a sign that we could have a steep rally. And the fact that the 10 verse 2 year has inverted, but the 10 verse 3 month has not, a lot of people are nervous that the Fed may tighten, and have monetary tightening. But if the 10 verse 2 year has inverted and it is an indicator of a recession, the Federal Reserve, I highly doubt, will actually, tighten policy, because if they believe they're heading into recession, they're not going to tighten and have monetary tightening, right? So this is just what I wanted to show you guys, because a lot of people see the inversion or hear about the yield inversion and don't realize that it's also an indicator for a massive rally to ensue shortly thereafter, right? So imagine missing out on these rallies because you heard that it inverted and you just sold everything, and then you missed 25% increase. Even if you caught 18% of that, over here 42% from the first inversion, that's a big gain, right? So this was 1998, right before, this is the tech bubble, right? So that was a massive rally. So yeah, so right now I believe we're in the last leg of this market, and we're gonna have this inversion, and we're gonna see some steep prices, and it's gonna be, I think, very nice to watch. But when the 10-year and 3-month also start to invert, that may be a sign that you gotta maybe get out of the market, right? So let's give an example of, so let's just pull this out. Yeah, so just keep that in mind. So let's go back to the Bitcoin. So we were looking at the Bitcoin versus ETH. Let's look at the total 3 now. So the total 3 altcoin market cap. So like I said, we've drawn support and resistance lines. So I mean all resistance lines until their support. So we had a pullback a couple days ago, just right on support. And we're moving up and we're heading to the next resistance. So a pullback may come, Monday, Tuesday, or we can just blast through these. But it's always good to have this on the chart, so when a pullback is happening, that it's just having some friction with the price, and we'll be heading up shortly after, considering we are in the beginning of what I believe wave 5 of this bull market. So like I said, if we go here, we have the Elliott wave theory. Wave 3 is always bigger than wave 1 and 5, but wave 5 is steeper and faster than wave 3. So we have impulse wave, a corrective wave, impulse wave, corrective wave, and then we are just at the beginning of the final impulse wave of this market cycle. So after this does happen, we are anticipating a bear market after we reach the top or close to the top of these regression bands or growth zones. So after we reach close to the top of this band, we are anticipating that the top here, so between around 70,000, could be the bottom of the next market, further out, maybe it's 2020, 2024. So that's just something to keep in mind. And like I said, while we were in the corrective wave, I maintain that purchasing Bitcoin in these zones, these zones, is always a good probability entry, and there's less downside but more upside. So as we continue higher, just keep that in mind, that this, I do believe, is the last wave of this cycle. And if it is, please take your profits. It's been a fun ride for everyone. And over here, when we've broken out, we had a nice rally, came back down, retested, broken out, we had a nice rally, and currently we have broken out, and we should see a nice rally to the upside. So enjoy. Thank you so much for watching. And if I didn't say at the beginning, I'm not a financial advisor. All this information is just for entertainment purposes only. And please like, comment, share, subscribe, and enjoy the rest of your weekend. Thank you.